Hello and welcome to Gold and Silver Assets. It's Sunday the 26th of July 2020. So the other day I was talking to someone who had bought gold when it was priced at 1800 New Zealand dollars. And at the moment it's over 2,800 New Zealand dollars. He's got some extra cash and the problem is he thinks that the current price of gold is too expensive. So the issue here is something called anchoring. When you become anchored to a certain price, then anything that's higher seems expensive. And that got me thinking, is gold and silver cheap at the moment? And there's lots of ways of looking at this, but today I'm just going to concentrate on one aspect, and that's inflation adjusted prices. So for those of you who haven't seen last week's video, I suggest watching that one first, as today's video is a kind of part two to that one. So I am going to be showing some price charts for various asset classes, and it's important to remember that the charts are only general representations. They don't tell us the whole story. For example, they don't account for things like trading fees, lawyers' fees for buying property, or currency exchange fees, for example. It also doesn't account for investments that usually have ongoing costs, such as holding mutual funds, management fees, storage fees for gold, mortgage interest, or property maintenance and property management fees. Dividends and income are also not included in this. Taxes such as property taxes or capital gains taxes also affect the gains and basically reduce them. And the other thing that charts don't account for is leverage, which has the effect of either magnifying the nominal return or magnifying the nominal loss. I wanted to start by looking at stock market returns over the last 46 years. And this chart has been indexed to 100 so that we can compare them. The blue line here shows the Nasdaq, and we can see that it's very clear that it has consistently outperformed the Dow and S&P, which are shown in red and green here. And this gap is absolutely huge. So there's absolutely no denying that tech stocks have been the place to be. Remember, these are US indices, and in fact, indices around the world haven't fared quite so well. So for example, in the UK, the stock index there is currently at roughly the same level as it was in 1998. And the Australian index is the same level that it was in 2006. So last week I showed this chart showing the indexed nominal returns for gold and real estate. And I wasn't able to include the Dow or S&P on this, as the Federal Reserve data only starts in 2010. I'm not sure why that is. However, I did say that when I calculated it manually, the Dow was at 3,220, which is roughly over here. I was, however, able to add the Nasdaq, but remember the Nasdaq is very skewed upwards compared to the other indices. And we can see from this chart that all of them beat CPI. So CPI was somewhere down here. Of course, the Nasdaq had the best performance, followed by gold, followed by the Dow and S&P, and then the lower performance was actually through real estate. What happens if we adjust the returns in terms of purchasing power of the US dollar? And again, I've indexed everything to 100 in 1971. And we can see that of these, gold is actually the only asset that is cheaper than it was in 1980. Everything else has consistently and steadily appreciated in price. And remember that this is all using the official government CPI values. In last week's video, we suggested that the rate of inflation is higher than the official CPI would suggest, partly due to changes in the way CPI is defined. Now, some might say, well, what does a few percent here or there matter? Well, I think it matters a lot due to the power of compounding. So when it comes to investing, compounding is one of the wonders of the world. But when it comes to things like inflation, compounding is a nightmare. This chart shows the cumulative index CPI measured in different ways. So that includes the shadow stats method, the Chapwood method, and as we can see here, the lowest value is actually the official CPI method. Discrepancies do compound over time, hence the big gap between these values here. And we can see that the divergences seem to start to occur in the early to mid 1980s here. Now, it's up to you to decide which of these you believe to be the correct level of inflation based on your experiences. According to this chart, this suggests that in the 70s and 80s, the official CPI was actually close to the reality, whereas in current times, there is a suggestion that there is a big divergence between the real inflation rate and the quoted CPI. Moving back to gold, this chart shows the price of gold in blue, so this is the nominal price, and the red line shows the inflation adjusted price using the official CPI figures. And then we have this green line which shows the gold price adjusted using the shadow stats CPI based on the 1980 method. So overall, it really depends how much inflation you believe there really is. If you believe that there hasn't been much inflation, or no inflation at all, in fact, then the blue line is the correct line, and indeed gold could be seen as being the most expensive that it's ever been. However, if you believe that inflation is greater than the official figures, then actually gold is relatively cheap compared to previous years. Now, this chart is based on 2011 US dollars, and so the value of that peak in 1980 is $7,000. Now, that value will vary depending on which year of US dollars you're using. And so here's the shadow stats chart using 2018 US dollars. And we can see here that instead of 7,000, that peak has gone up to over 12,000 US dollars compared to 7,000 in the last chart. So overall, when we look at this chart, it suggests that when we compare like for like, gold is actually cheaper than it was in 1980. But the other thing to remember is that conditions were very different in the 1970s and 80s. At that time, inflation was actually quite high. In this chart, we can see the inflation rate in 1980 reached over 13%. Also at that time, as we showed earlier, the official CPI was probably closer to reality than it is now. So at the time, faith in the US dollar was probably shaken. However, at the moment, the general public do seem to have full faith in the US dollar. And perhaps part of that might be because the quoted CPI is actually pretty low over here. And so that might be giving a false sense of security. The shadow stats figures suggest that the current inflation rate annually is closer to about 8% over here. So perhaps if inflation does become more obvious to the general population, then gold price will move closer to its 1980s and 1970s kinds of levels. If the inflation rate in reality were to exceed that 13% peak that we saw in 1980, then that tells us that gold has a lot higher to go. But again, all of this hinges on what your expectations are with regards to inflation. Inflation adjusted silver is even more extreme than gold. So in current dollar terms, we are way below the 1980 peak, which reached almost close to 120 US dollars. And the situation is even more extreme if you use the shadow stats CPI, which in 2018 US dollars shows that the peak silver price in 1980 was over 680 US dollars. The upshot of all this is that if you believe that inflation is going to become more obvious to the public and that inflation rates can get to or exceed 13% levels that we saw in the 70s and 80s, then yes, gold and silver are cheap right now. Next up, the market update. Amazingly, last week we didn't get a single troll in the comments, and in fact we had some really good discussion points that were brought up by our viewers. And I particularly enjoyed some of the comments about explanations of why the volumes are down for the mining stocks. And I really encouraged that. That was really good. I'm not one of those people that thinks that I know it all. I certainly don't know it all. And so it's really good to hear different points of view. I'm more than willing to change my opinions on things so long as there's reasoning behind it. So great work, everyone. Keep it up. Now, we have had a momentous week in terms of the precious metals, and some of the moves that we've seen are of great significance, and I'll talk about why. So let's crack on. We'll start with gold priced in US dollars on the weekly scale, and previously we had drawn this upper trend line which had held for 3 times, so there were 3 hits here, and last week we were trying to decide whether this was just going to turn back down, but instead it just blasted through that. That's a big green candle that we're seeing there. And this week we've actually closed just a gnat's crotchet above 1900 US dollars. The other thing to note is that we were talking about this RSI and were wondering whether this was bearish divergence, but I did say that this could be negated if we break this line here, which actually occurred. And so there's still some headroom here. This can still go up to above 80. And so all of this tells me that I think we've got more upside coming. Why do I think that? Well, as well as what I've already mentioned here, if we move on to gold in US dollars on the monthly scale, we were talking about this rounded pattern here. And so the options were, is this a cup and handle pattern? It's just that we haven't formed the handle, or is it just a cup? Remember that the handle is an optional thing. It doesn't necessarily have to occur. And if we assume that the left lip is over here, then we've actually broken through that. And so there wasn't really no handle. If we assume that the left lip is up here, then that's a different matter. That's at the 1920 US dollar level over here, and we haven't quite reached that. Now, this is a very, very bullish pattern, regardless of whether we have a handle or not. And if this plays out, then we're looking at a target of 2,550. Now, of course, that's not going to happen overnight, but I don't think we're going to have to wait years and years for that to occur. Of course, it's not going to reach that level in a straight line. And of course, once we get above that 1920 US dollar level, then we're in blue sky territory. And so we have no clues about future resistance levels. But of course, there are some kind of generalizations that we can make. So often round numbers can tend to be resistance levels. So if we're looking for shorter term pullbacks before the next leg's up, then what we could do here is a few things. One is that we could hit that 1920 level and then come back down a little bit before moving up. But I think this has got a lot of legs to it. It could still push through to 1950, which I think is probably the most likely level I'm looking at. But it could even go up to 2000, which is a very nice round number there. So I suspect it's going to hit one of those three levels. But I think we are due a pullback, because remember, we've had 4 monthly candles in a row. I think the most we've seen historically, if you've watched some of my previous videos, is 6 green candles, and that was during that parabolic move in the 1970s. So I am expecting a red candle at some point in the next couple of months, but I'm not expecting a massive red candle, and I'm certainly not turning bearish on this in any way at all. Long term, I remain bullish. If it were to pull back, then where would it go to? It might only be a small pullback. So if we come up here, it could just be a small consolidation before moving upwards. So it might not be anything particularly drastic. Possibly we could go back to support here, which is in this zone of around 1800 to the 1741. And anything lower than that just seems rather unlikely. I mean, it's not impossible, but there is a lot of strong support at 1600. But I just find it hard to think that it's going to drop by that much. That's quite a large drop. So I think most likely we're going to get a move up and then a dip down, but I don't know how far that dip's going to go. Moving on to silver in US dollars on the daily scale, and this is one where this is of great significance, this move, even more significant than what we've seen in gold, and this is what is really making me very, very bullish. So I'll explain why. Now, we left last week on this candle here, and it had closed just above this trend line over here, and we were uncertain if silver was just messing about with us. Silver can be quite wild, and it can mess around with you. But of course, the following day we had a decisive move up through here. And the other thing that I mentioned in last week's video was that if we were to get a definite break of this area, then price would move pretty quickly. And there's a lot of thin air between 19 and 27, which I'll show you in the next chart coming up. But there's no denying this is a rapid move up here. As we moved up, we broke through this upper channel trend line, and you can see that we actually retested it before making the next move up. And we've taken a bit of a break over the last 2 days, but this doesn't look weak to me. This doesn't look like it's going to come crashing down, next week or anything like that. This is actually looking pretty strong. So let's just zoom out again and look at silver in US dollars on the monthly scale. And here is that nice green candle that we saw. And this is the area of thin air that I'd been talking about. So there's still quite a lot of space above where there's little or no resistance. As I said, the move would kind of go something like this. And I think that we're actually at that stage where we're having a little bit of a break before pushing up to here. And the reason that I'm talking about the 27 level is that we've got a lot of price action over here that is likely to be some form of resistance there. And so that's where I'd expect a reasonable size pullback to occur. How big that's going to be, I don't know. But I suspect that that will be what coincides with that pullback in gold. Why do I say that this move has been of great significance? Well, the reason is that we've broken out from this long-term bottoming channel we've had for years and years, and this is what's frustrated a lot of investors. In my video about the anatomy of bear bottoms, you'll remember that I said we were in that despair overshoot phase for silver, and therefore I thought it was a reasonable time for me to be stacking the physical silver around here. But of course, I didn't know when this was going to break out. And that's one of the things with this, is being patient. I was pretty happy with being patient though. And the reason is that I think silver is a hugely asymmetric trade. Is it still asymmetric? Absolutely. Even at these prices, I mean, some people might be thinking, oh, I've missed the move and it's too late. I don't believe that to be the case. The way I look at it is that you've got to think about what is the downside and what's the upside with this. In the current environment, I think the upside is huge, and we've talked about the various fundamentals in the first section of many of my videos. So you will understand why I think the upside is very much a big possibility there. In terms of downside, well, the first thing to note is that we've broken out of this channel, and I think we're unlikely to re-enter it. I think at the very, very most, and I don't think we'll even do that, is a retest of the top of this channel here. So I would say that's your downside. And look, even if it did break that channel top, I can't see it going below 16. Just because there's so much support here for that. So that's your downside. But the upside, look, although we're talking about a pullback at 27, you know, I think we're going to hit these all-time highs, you know, within reasonable time scale. I can't tell you exactly when, but I think that's definitely on the cards. And beyond that as well, it wouldn't surprise me, based on all the things that I've been looking at, if we were to get triple figure silver within the next 3 years. That wouldn't surprise me one bit. So that's the way I like to look at these things. Of course, it does require patience. You know, it's not something where you can just make a quick buck, because this is a very, very volatile commodity here. But you know, for those who are impatient, this is actually a big plus, because we've got a higher high basically, and we've got continuously higher lows here. And so I think this basically means that a bull trend is in place. Now, if you look back in April, one of the things that I had talked about was the correlation between silver and the gold and silver ratio. Now, at first glance, this chart looks quite complicated, so I'll just explain what the various things are. So in grey here, we have the silver price, and in blue, we have the gold to silver ratio. And as you know, we had this massive spike in the gold to silver ratio, which has since come down quite dramatically. And below here we have the correlation coefficient between silver and the gold to silver ratio. And we can see that the majority of the time they are negatively correlated. So when silver price goes up, the gold to silver ratio drops. But remember that I spoke, so this was in the video about the gold silver ratio and house prices. But in that video, I mentioned that there have been occasions where the gold to silver ratio correlation with silver has been positive. And it hasn't occurred many times, but I thought it was very interesting and I wanted to look at this prospectively, and it seems like it's working out. So let's just go back to 2003, and the gold to silver ratio went positive, and I've drawn the red line here roughly where it flipped from going positive back to negative. And what we can see here is that that was the start of a big move up in the silver price. And actually kind of it tripled up to 15 here before taking a break, and then went up to 20. So that was a good run there. Now the next time that it did that, where it went positive and then just flipped down to negative, I wasn't able to draw the line exactly on that spot, but what we saw this time was that silver price actually dipped at that flip point, but that actually seemed to foresee another big move in gold, and this was actually much bigger than the move we saw back here, and prices went from just below $10 up to almost $50 here. So that was a huge run up. And back in April, I talked about how, again, we'd seen that positive move in the correlation, and that had just flipped roughly in February. It was actually, the line again is just a little bit off here. And again, silver price had dipped down, and so I was wondering if that was going to foresee a big move up, and it looks like that's something that's occurring. So remember that nothing works 100% of the time. You might find an indicator or something that works for a while and then it stops working. So, you know, there's nothing that's 100%, but I was pretty happy with how this has been working out. And so it's something that I will keep an eye on in the future, because of course there will be times when silver takes a break before making its next move up again. But remember, this is only really for the monthly scale and on the longer term charts here. And finally, we'll move on to the miners. This is the GDX. And the miners have been moving up steadily. It's a little bit strange though, because if you remember on the gold chart, we had a massive move up in the past week, and certainly we did move up reasonably well over here, but we seem to have stalled out a little bit. That doesn't mean that we haven't got more upside. More upside is certainly on the cards if we're going to get upside in the price of gold. And so we have to keep assuming that this is going to go up unless this lower trend line gets broken. So let's keep watching, but it's an exciting time in the precious metals. Enjoy the ride. It won't be a straight ride. It will be a bit of a roller coaster, but certainly enjoy it. So some of you have mentioned that you enjoy listening to the show with a nice cup of coffee. Me, I'm a tea person myself, but hey, any hot drink is good with your feet up on a Sunday morning or afternoon, depending on your time zone. All right, anyway, that's it from me. All the best, and see you next week. Bye.